In Kenya, tax collection for the first 9 months to March was short of the target by $928.9 million, mainly due to reduced economic activity and drought that hit agriculture. Nearly a third of Kenyans have not filed their tax returns 7 days to Sunday's June 30th deadline, exposing the 1.3 million non-compliant individuals and companies to fines. Mugendi, Assistant Manager in Public Markets at Cytonn Investments, joined us earlier for more.
Kenyans have a tendency of liking to do a lot of things last minute. I'm sorry to say, but it's something that is known. Even if you can look at previously, even during the deadline for Huduma number, we had huge queues towards the last day. And I guess the same is expected with the tax filing returns. Despite the fact that KRA has actually made it quite easy to file returns, you can do it from the comfort of your home. You just need to log in into iTax and you can get the process done. However, now waiting for towards the last minutes of the last day, there's usually a tendency for the website to hang, and that make your filing process a bit lengthier.
Yeah, so you're hopeful that more people will actually meet the deadline?
Yes, the deadline is still there. After 30th, if you haven't filed your returns, you shall be penalized. So I hope more and more Kenyans can use the time and towards the end of the week and the weekend to file their tax returns.
Yeah, and then when you look at the tax collection for the first 9 months to March this year, they fell short of the target by 95 billion Kenyan shillings. And the Kenya Revenue Authority has also revealed that they expect about 4 million people to have processed for their returns by the end of this year. Now, what impact will this have on the economy if that is not met?
Well, for the longest time, for the recent past, the KRA has not been actually achieving its revenue targets. I think that 95 billion less is close to just a bit more than close to 10%, around 9 to 10% less its prorated target as at the last reporting, maybe in April or May. And we also don't expect that to be the case. We don't expect the KRA to achieve its revenue target for the 18-19 fiscal year by the time of June 30th. So the KRA has been coming up with new measures, especially also in the finance bill and the budget. We've seen new measures that the taxman has come up with in terms of trying to collect more revenue from businesses and from individuals.
Yes, and we're seeing that Kenya has also been blamed for having a very small tax bracket that does not really involve the informal sector, as well as when we also look at the self-employed people. Now, what is your opinion around this, and do you think that the tax law in Kenya should be reviewed?
Well, in terms of trying to rope in the informal sector, I think some progress has been made with a number of new tax measures that have been introduced. The income tax law this time around is a bit more comprehensive. We're having more tax on the usual excise duty goods that are being taxed at a higher rate. We also have a tax on gambling. We have an increase in capital gains tax on the sale of property and land. And some of these tax measures have been introduced. Actually, they've been in the works, and expected some of them to be introduced this coming fiscal year. Also an increase in taxation on imported cars and the like. So I would say that there's no need to review the income tax law. However, maybe some amendments here and there, because a lot of businesses shall be affected. We might see a slowdown in some of the sectors where tax has actually been increased, and hopefully an improvement in the sector where tax has been reduced.
Yes, and when we look across the Nairobi Securities Exchange, we're seeing that 8 firms have used approximately 2.7 billion Kenyan shillings to lay off workers the whole of last year. Now, what is influencing this?
Well, last year, basically, most of those companies were in the banking sector. We had the likes of Standard Chartered, KCB, NBK, and the like that had a restructuring process that they were currently undergoing in the previous year. So we found that most of these were brought out by the interest rate cap law that came into effect in around 2016. So banks were trying to minimize their costs since their revenue basis in terms of interest had been capped due to the law. Despite this, we've seen a number of other firms also in non-banking sector also had some cuts, and they had to expand in terms of their wage bill. Basically, it's due to the harder operating environment that we found ourselves in. Despite the fact that the economy grew by close to 6% last year, a lot of businesses were struggling. The operating environment was a bit tougher last year. We can attribute this to a number of things like some of the drought, a slowdown in government payments. We had lack of credit to the private sector and the like. So a lot of businesses were restructuring and trying to reduce their cost base, and one way of doing that is laying off employees. But in doing so, the first year you have to actually pay a lot of higher wages as you let them take voluntary early retirement and such packages.
Yes, and when you look at this year, do you think that the same factors from last year will also carry on to this year and force the sector to have the same results?
We do expect still some restructuring to continue in the banking sector. However, we also expect a lot of consolidation that's happening. One of the key metrics that you have to take into consideration, the Competition Authority of Kenya has to take into consideration when businesses are being acquired, is the effect on staff and staff turnover. So there's going to likely be some cases where, despite the consolidation or the acquisition and merging, employees will not be let go of. There will not be a lot of retrenchment in the industry. Despite that, I think we've seen a lot of the restructuring having come through. A lot of bank closures already happened in the past, so we don't expect so much of the same this year.
Yes, and now we've seen that the governments of Kenya, Tullow Oil, Africa Oil, and Total signed a deal to develop crude oil facility in Kenya. Now, what impact will this have on the economy?
Well, we do know that the emergence of oil in the Turkana Basin actually has a positive effect because it's going to bring in a new sector, that is oil mining, gas and exploration sector in Kenya, which will have a positive output in terms of economic output, and we expect this also to contribute to an increase in revenue for the country as we sell the crude oil. For Tullow, it's a known oil exploration company, and we do expect them also to reap the benefits once they finalized the investment, once they've come up to the conclusion of the final investment date, and once that is finalized. So we do expect to start exporting some barrels of oil. I think the number has been revised upwards in excess of 2,000 barrels per day, and we expect that to also contribute favorably towards the economic output of the country.
Yes, now we're seeing that the government signed the agreement with Tullow Oil alongside other oil exporter companies, but now there's also another project that Tullow Oil has delayed to give its final investment decision in Kenya. The project was supposed to start in 2020, but till now they have not yet given their final decision. Now, why the delay?
Well, some of these issues tend to be marred a lot because of the effect that it will have on the environment, the social, and the governance ESG analysis. So a lot of this might come from the fact of what is the deal going to have, the impact of the deal on the communities that are going to live there, on the governance, and on the local setup. So there might have been some delays in that assessment. And that might have caused some delays in actually coming into their final investment decision day.